Fact 1. Money is not coins or paper, but a technology for accounting trust. Historically, people used anything: cowrie shells, salt, furs, grain. Later, metal coins appeared, and even later, paper receipts from merchants and the first banknotes, which were essentially debt obligations. With the development of states, the right to mint and issue money became a monopoly of power. And since the 20th century, most currencies have ceased to be backed by gold. Their value is maintained by legal norms, scarcity, and society's willingness to accept them in exchange. Modern money is an entry in a ledger kept by banks and payment systems. Cash is just a convenient offline format of this entry. An important conclusion is that currency stability is a consequence of institutions and trust in them, not the color of ink on a banknote. Second fact: inflation is not the price increase itself, but a decrease in the purchasing power of a unit of money. When people say inflation is 6% this year, it means that to buy the same basket of goods, you need 6% more money than a year ago. It is insidious due to the compounding effect. A small annual price increase accumulated over decades turns former sums into a shadow of their former strength. Inflation hits cash savings and fixed incomes, but helps debtors. Nominal payments remain the same, while the money lightens. There is also inflation's quiet sister, shrinkflation. Manufacturers reduce the weight and volume of packaging without a noticeable change in price. Deflation, on the other hand, sounds attractive but is dangerous. People postpone purchases, the economy freezes, and debts become heavier. Therefore, moderate, predictable inflation and indexation are important. Fact 3. Compound interest is the main driver of both wealth accumulation and debt traps. When interest is calculated not only on the initial sum, but also on previously accrued interest, the trajectory becomes exponential. The simple rule of 72 helps estimate the time it takes for capital to double. Divide 72 by the approximate annual return to get the number of years. This works in reverse for debts and penalties as well. Credit cards with high interest rates can turn a little borrowed into a multi-year bondage if only minimum payments are made. An early start is critical. A year gained at the beginning is worth more than a year added at the end of the horizon. Fees and taxes eat away at the effect, so low costs and tax-advantaged instruments are important where legally permissible and available. The math is the same, the outcome is different. Fact number 4 states that a budget is not a restriction on enjoyment, but a plan of priorities, with pay yourself first as the top line item. The pay yourself first method means automatically transferring a portion of your income to savings immediately after receiving money. This way, the remaining amount adjusts to your life, not the other way around. The zero-based approach allocates every dollar. Whatever is not designated will be spent. The envelope system adds psychological friction. Separate wallets for food, transportation, and entertainment provide clear signals when it's time to stop. The 50-30-20 rule is not a dogma, but a template that should be adapted to reality. It is important to account for irregular expenses. Appliances break, taxes are due, vacations happen. They need their own pocket. Automation reduces slip-ups, and daily monitoring is not micromanagement, but feedback. Fifth fact: the reserve fund is personal insurance against chaos, not dead money. Its purpose is to buy time, to calmly look for a new job, to wait out an illness, to cover sudden repairs without a credit spiral. The classic recommendation is to keep 3 to 6 months of expenses in it, and with unstable income, closer to 6 to 12 months. The criteria are simple: maximum liquidity and minimum risk. This means a highly reliable account or deposit with quick access, not volatile assets. It is better to separate this fund from everyday money and not mix it with investments so that the hand does not reach to borrow from the future self. Paradoxically, even a modest reserve reduces anxiety and improves decision-making quality. When a fire is not immediately threatening, there is no need to sell assets at the bottom and take expensive loans. The sixth point addresses insurance, which acts as a personal budget seatbelt. It doesn't make you richer, but protects you from financial disaster when a rare but costly event disrupts your plans. The basic logic is simple. What happens infrequently and is very expensive is best transferred to the insurer's balance sheet. Medical care and loss of ability to work, death or damage to your home, liability to third parties. Frequent and inexpensive events are more sensibly self-insured with a reserve. Key terms in a policy are deductible, limits, and exclusions. The higher the deductible, the lower the premium, but the more you pay out of pocket. Limits define the ceiling, and exclusions indicate where protection is entirely absent. It's important to understand waiting periods and payout conditions, and to keep copies of documents and photos of your property. A policy with unclear terms is an illusion of protection. A policy tailored to your family's and region's risks is a tool for stability. Fact 7. Diversification is not about buying many things, but about distributing capital among sources of risk that behave differently. Stocks, bonds, cash, real estate, global and local markets, their returns do not march in step, and it is this disagreement that smooths the capital's trajectory. But correlations are not set in stone. In a crisis, they tend to approach one, and the portfolio suddenly begins to fall in unison. Therefore, the role of cash and quality bonds as a shock absorber is difficult to overestimate. Rebalancing restores target allocations. We sell what has grown and buy what has fallen, mechanically selling high and buying low. Costs and taxes are important. Infrequent, disciplined rebalancing is cheaper than fuss. Low-fee index funds often become the base, on top of which more risky ideas are added. Eighth fact. Money psychology is more powerful than a calculator. We spend more with a card than with cash because the pain of payment is dulled. A today-only discount triggers the fear of missing out. Buy now, pay later masks the real price. The anchoring effect makes us consider a price adequate when it's shown next to a deliberately inflated one. Loss aversion keeps unprofitable assets until zero. Mental accounting creates false pockets where one money is spent without a second thought. The antidotes are grounded, a pause before a large purchase, lists and limiting channels for impulse spending, automatic transfers to goals, physical separation of accounts, and cooling the cart for a day. Once a month, it's useful to look at the annual picture. Context dampens emotions and restores proportion to decisions. Fact 9. A loan is the price of accelerating time. You get a thing now, pay later, and the difference between now and later is your interest overpayment. It's not just the nominal rate that matters, but also the effective cost of the loan, fees, insurance, and the method of calculating interest. In an annuity payment schedule, the first payments consist almost entirely of interest, the principal debt decreases slowly, and early repayment in the first half of the term significantly reduces the overpayment, if there are no penalties. A mortgage relies on collateral and the debt-to-collateral value ratio. The higher the LTV, the more expensive the rate and the stricter the requirements. A fixed rate provides predictability, while a floating rate carries the risk of payment increases when rates rise. A credit card is the most expensive form of debt after penalties in microfinance organizations. The grace period is only beneficial if the debt is fully repaid by the due date, otherwise compound interest works against you. 10th fact. Taxes are another layer of personal finance reality, and they depend on jurisdiction, but general principles repeat. There are taxes on income, capital gains, dividends, and property. There are tax-deferred regimes and tax deductions. There are progressive scales and thresholds. Reporting, supporting documents, accounting for the base and holding periods determine how much will remain in hand after a transaction. Long-term asset holding is often taxed more leniently than short-term. Reallocation between accounts with and without benefits changes the final return no less than a successful fund choice. Optimization must be legal and transparent. Penalties for mistakes can nullify savings. The universal advice is simple. Plan transactions with taxes in mind in advance and clarify the rules in your country from reliable sources. Fact 11. High income and wealth are not synonyms. Capital grows not from the figure on a payslip, but from the difference between what comes in and what goes out. This gap is called the savings rate, and it is more effective than any secret strategy. Two people can earn the same amount, but one sets aside 30% in automatic transfers for goals and investments, while the other spends almost everything, raising the consumption bar with every raise. After a few years, their net worth, assets minus liabilities, looks like two different worlds. Lifestyle inflation creeps in unnoticed. New subscriptions, upgrades because I can, the reflex to pay a little more for convenience. The antidote is conscious boundaries. Indexing joys no faster than inflation, a planned freeze on spending levels when income rises, and regular checks of net worth, not just card statements. Income is a flow, wealth is a reservoir. Fact 12. Financial goals are effective when they have a specific destination, a deadline, and a measurable way to track progress. The phrase, "I'm saving for everything," is vague, while in 18 months, I need to make the first payment for housing requiring approximately this much, and I'm setting aside this much monthly, becomes a clear route. A convenient structure for goals involves buckets. Short-term goals, up to 2 to 3 years, are managed with highly liquid and low-risk instruments. Medium-term goals use instruments with moderate volatility and defined timelines. Long-term goals, over 5 to 10 years, are invested in market assets where fluctuations are expected, but the reward for patience is higher. The present bias tempts one to rewards now. Automating contributions and visualizing progress counteract this. A quarterly self-board of directors meeting is useful for reviewing the amount, timelines, and assumptions, and for adjusting the course without panic. A goal doesn't have to be unchangeable, but changes should be thoughtful, not a reaction to a headline. Fact 13 states that investing is primarily about managing costs and discipline, and only then about choosing ideas. Fees are a hidden enemy of compound interest. A difference of fractions of a percent annually over decades neatly reshapes the outcome. Low-cost index funds and ETFs often serve as a foundation because they provide broad market exposure without trying to guess which individual name will take off. Actively selecting stocks or funds can be successful, but after fees and taxes, it's hard to consistently outperform a benchmark, as many comparative studies show. The practical conclusion is, if you lack time and expertise, choose a simple and inexpensive core. Market timing is tempting, but a significant portion of annual returns can come from a few bright days of growth. Missing them cuts the investor's result. Therefore, a time in the market strategy plus periodic contributions and infrequent rebalancing often beats fuss. Fact 14. Currency risk is a quiet companion of the global world. You earn and spend in one currency, invest in assets denominated in another, and exchange rate fluctuations interfere with the outcome. The basic principle is simple. Keep your safety net and large future expenses in the currency in which the expenses will occur. Diversify investments across countries and currencies to avoid dependence on the fate of a single issuer and a single economy. When exchanging currencies, consider spreads and commissions, because a cheap rate often hides an expensive markup. There are tools with currency hedging, smoothing fluctuations, but hedging has a price and is not free, especially over long horizons. Currency jumps can amplify or erode returns for years, and this is normal. It is more important that the risk matches the goals and timelines and that the decision is systemic. Clear proportions, a rebalancing rule, discipline. Fact 15. Payment security is built on habits plus technology. Card tokenization and 3D Secure reduce leak risks, but the human element spoils things. Courier from the bank, urgent calls, links to confirm transaction, classic traps. Golden rules are boring and effective. Never dictate codes in CVV, don't click links from blockage messages, call the bank back using the number on the card. Useful are separate virtual cards and reduced limits for subscriptions and online purchases, instant push notifications, and one-tap card freezing in the app. Avoid transactions on social networks. Install updates and unique passwords on computers, store them in a manager, and enable two-factor authentication. Check statements at least once a week. Transaction disputes have deadlines. For travel, a backup card and document copies. For transfers, a test amount before a large one. The risk doesn't disappear, but it becomes manageable. 16th fact. Pension planning is a decades-long project where the main variables are the horizon, the desired income replacement, and tolerance for fluctuations. The longer the road, the larger the share of stocks a portfolio typically holds, reducing risk as the goal approaches, the so-called glide path. The risk of return sequence is important. Two portfolios with the same average return yield different outcomes if the first years of retirement coincide with a downturn. The antidote is a liquidity reserve for 2 to 3 years of expenses, a flexible withdrawal rule, cut back in bad years, index in good ones, as well as annuities and pensions where they are transparent and have a reliable issuer. Indexing expenses for inflation is mandatory. The basket of expenses changes. Medicines and utilities grow differently than travel. Retirement is not just about money, but also about time structure. The clearer the plan for the day and sources of income, the more stable the budget. Fact 17. Real estate is often considered a solid investment, but its profitability is not just about price growth, as it might seem, but about net cash flow, taking into account all hidden expenses. These expenses include taxes, insurance, repair costs, periods without tenants, agent fees, moving expenses, and loan interest payments. All these factors reduce the actual return and require a liquid safety cushion. A home for living is a consumer good with an emotional component. A home for investment is a financial project where the capitalization rate, payback period, and exit strategies are important. The liquidity of real estate is lower than that of securities, as transactions can drag on for months and depend on market conditions. The decision to rent or buy is not an ideological choice, but a comparison of the opportunity cost of capital and mobility. Sometimes it is more profitable and flexible to rent, investing the difference in diversified assets. Real estate markets are characterized by heterogeneity. Average figures for the country hide differences between districts and streets, where the rules of the game can change on the next block. Fact 18. The primary asset for most people is not their portfolio, but their human capital. Skills, reputation, health, the ability to learn, and the capacity to market their expertise. The income derived from it is a stream that can be increased through task-oriented training, certifications, languages, compensation negotiations, and the ability to gather evidence of value, results, metrics, cases. The return on investment in skills is often higher than the market average. One successful upgrade can increase one's rate for years. Income can also be diversified. A basic job plus project-based employment, royalties, shares, author products, provided that health and the main source are not compromised. A network of contacts acts as a multiplier. Weak ties often bring new offers if they are maintained naturally and without spam. Furthermore, professional risk management involves having reserves, ensuring one's ability to work, regular medical checkups, and burnout prevention, because a physical slowdown means a halt in cash flow. The 19th fact states that debt exit strategies work best when they combine arithmetic and psychology. The avalanche method directs extra money towards the debt with the highest effective interest rate, minimizing overpayment. The snowball method pays off the smallest debts first, quickly creating a sense of progress and freeing up payments for the next step. Both methods require a foundation, fixed minimum payments for all obligations, and a reserve for minor emergencies so that a new penalty does not nullify the efforts. Negotiations with creditors are beneficial. Restructuring, rate reduction, payment date deferral. Miracle consolidations without transparent terms and microfinance organizations with hidden fees are dangerous. Refinancing mortgages and car loans makes sense with clear savings on the total cost and reasonable terms. The meta rule is simple. Stop accumulating new debts until victory. Otherwise, no strategy can fill a leaky bucket. Fact 20. Financial protection for a family involves documents as much as money. A will, instructions for accounts and beneficiaries, powers of attorney for loss of capacity, and guides for digital assets and passwords all clear legal fog and speed up access to funds when times are already difficult. Life insurance covers the risk of a breadwinner's premature death. It is sufficient to cover a few years of family expenses and major debts. An excessive amount is overpayment for peace of mind, while a shortfall is false economy. It is important to keep everything in a package: copies of policies, a registry of accounts, consultant contacts, and a step-by-step what to do if plan. For parents, it is important to arrange guardianship in case of simultaneous loss, and for entrepreneurs to provide for partners' access to operating accounts within the law. Regular annual review synchronizes sums and asset composition with current life. A child is born, income grows, an address changes, documents also change. Fact 21. The total cost of owning an item is almost always higher than its price tag on the display. A car is a classic example. In addition to its price and any credit, you will face mandatory and voluntary insurance, taxes and technical inspections, parking fees, tires and their seasonal replacement, routine maintenance and unforeseen repairs, fines, depreciation upon resale, and even the time you spend on all of it. The largest hidden cost is depreciation. New cars lose value fastest in the first few years, and this can cost more than fuel. For gadgets, subscriptions to software, accessories, screen repairs, and rapid obsolescence are added to the bill. For housing, there are utility bills, furniture, insurance, deposits, commissions, and downtime during moves. A sensible approach is to calculate expenses for the entire ownership horizon. How many kilometers, hours, or years you will realistically get out of a purchase, and what each will cost. This way, what seems cheap can sometimes turn out to be expensive, and renting can be more rational than buying. Fact 22. Opportunity cost is the invisible price tag of any decision. By choosing A, you automatically forego B and its benefits. Holding a large sum of cash may seem safe, but the cost is missed compound interest and the impact of inflation. The eternal debate of paying off a mortgage or investing is resolved by comparing after-tax figures and considering risk. Guaranteed savings on a high-interest debt is risk-free return that the market struggles to consistently beat. For cheap credit, the arguments are closer, and liquidity, money in assets is accessible, at home it is not, and psychology, freedom from obligations is also a value, are added to the calculation. The initial data table should include the rate, horizons, a buffer for emergencies, and deposit discipline. The universal conclusion is trivial yet powerful. First, pay off the most expensive debts. Then, balance accelerated repayment of cheap ones with investing in a diversified portfolio. Fact 23. A credit history is a numerical reputation that affects access to loans, interest rates, and sometimes even rental and insurance terms. The fundamental building blocks are similar across different countries. Timely payments, credit utilization ratio, the lower the better, stable values up to 30%, and even more comfortable up to 10%, history length, old accounts are gold, product diversity, and recent inquiries. Closing an old card can suddenly shorten the average age of accounts and worsen the picture. Conversely, sharp increases in credit limits before a large loan can appear nervous. It is useful to request a report once a year, where available, check for errors, and dispute them with documentation. If there is no history, it is created by responsible use of a small credit card with automatic full balance payment. The main rule is the same for all models. Discipline and predictability are more valuable than any life hacks, and a delay of a couple of days costs months of recovery. Fact 24th. Subscriptions are becoming the new utility bill, quietly growing from a dozen penny services. A trial with auto-renewal, an annual pre-installation instead of monthly, complex cancellation scenarios, bundles with discounts you don't use, these are classic attention economy tricks. To prevent money from slipping through your fingers, keep a registry of subscriptions with the price, debit date, and card holder. Set reminders 3 to 5 days before renewal. Use a separate virtual card with a low limit and instant push notifications. Check your statement weekly and conduct a dry cleaning every quarter. Turn off what you don't use. When changing your plan, keep screenshots of the terms. When prices increase, compare alternatives instead of paying out of inertia. The latte effect theory may overstate the significance of small things, but regular subscriptions are not trivial. They are a predictable stream that either serves you or serves someone else's revenue. Fact 25th states, children's financial education begins not at school but in the kitchen with clear family rules about money. Pocket money is a tool, not a bribe. A fixed amount on a schedule teaches planning better than asking when needed. The 3-jar system works. Spend, save, share. This fosters a sense of priority and empathy. A family bank with a fair interest rate on long-term goals demonstrates the magic of compound interest in practice. Payment for one-off projects, rather than basic duties, explains the link between value and reward. A teen card with limits and push notifications makes spending visible and safe. Review receipts, in-game subscriptions, streamer donations together, and compare prices and discounts. A separate lesson is safety. Don't share codes, distinguish advertising from advice, recognize schemes and phishing. This way, you raise not rich kids, but adults for whom money is a tool, not a master. Fact 26th. Irregular income is not a budget sentence if you first average your cash flow. The basic technique is to determine a minimum monthly salary transfer to yourself and adjust your expenses accordingly, directing all income peaks into a buffer. Such a buffer should be at least 3 to 6 months of average income and kept separate from the emergency reserve fund. The former smooths out seasonality, the latter saves you during force majeure events. Taxes should be set aside automatically each time payment is received, using a fixed percentage according to your country's rules, so that the quarterly payment doesn't hit like a hammer. Client terms are agreed upon in advance. Prepayment, payment terms like net 1530, late payment penalties, and acceptance criteria. Invoices are issued immediately upon completion of a stage, and reminders are automated. A financial cushion plus liability and health insurance reduces risk when a large contractor delays payment. And yes, a sales calendar is the same budget, just projected into the future. 27th fact. Financial fraud rarely appears as a blatant forgery. More often, it involves offers that are too good to be true. Red flags include promises of high returns with no risk, mentions of secret arbitrage windows, payment schemes funded by new participants, and aggressive urgency. Add to this perceived expertise through fake licenses and reviews, spoofed phone numbers, deep fake voices of bank managers, and links to messengers instead of official support. In investments, closed clubs without transparent reports and custodians, unaudited funds, and trust us with your money, we'll trade for you schemes are dangerous. Financial influencers are obligated to label advertising and disclose conflicts of interest. The absence of this is a reason for caution. Verify company registrations with the regulator, avoid transferring large sums P2P to strangers, diversify risks, and keep critical assets with trusted providers, not in exotic apps. And remember, a legitimate product can always be explained in simple terms. Fact 28. A salary offer is read like a financial document. Not only how much per month is important, but also the composition of the package. Distinguish gross from net, fixed from variable pay, one-time bonuses for joining, and annual bonuses for performance. Stocks can be varied. Options require paying a strike price and depend on fair value, while RSUs are without a strike, but vest on a schedule with a cliff. Taxes and liquidity differ. Find out the vesting period, if there's acceleration upon company sale, and the buyback policy upon termination. Compare insurance, additional payments for vacation and sick leave, matching contributions to pension plans, compensation for remote work and communication, relocation and visa support, and severance pay in case of layoffs. Clarify the probationary period, non-compete agreements, and rights to side projects. Bring everything to a 3 to 4 year horizon. Model several scenarios for stock price after taxes and compare with alternatives. Numbers decide. Emotions only add highlight. Fact 29th. Crypto assets are a highly volatile asset class where financial and digital hygiene are equally important. The rule, not your keys, not your coins, pertains to storage. Exchanges are convenient for transactions, but storing large sums is wiser in your own wallet, and keeping the seed phrase offline and in multiple copies. Hot wallets are convenient, while cold wallets are safer. Any QR code and smart contract should be checked twice because the irreversibility of transactions leaves no room for errors. Stablecoins are not all the same. Some are backed by reserves and reporting. Others are held together by algorithms and can break. Study the issuer's risk. Network fees and congestion affect the cost and time of transfers. Portfolio allocations should be moderate, with the thought how much you don't mind losing, as regulatory and technological risks are high. Transaction taxation varies by country and is often unexpected. Record transactions and keep statements. Discipline is more valuable than hype here. Fact 30. Charity and personal finance do not conflict. Systematic donations help both the world and your financial discipline. A working scheme is to choose a percentage of income or a fixed amount and make contributions regularly, not on an occasional basis. This makes planning easier for both funds and you. Check the transparency of organizations. Reporting, goals, impact metrics, independent audits. Popularity does not equal effectiveness. Employers sometimes offer matching programs. This doubles the effect without additional costs. In some countries, donations provide tax benefits. Keep receipts and clarify the rules. Large goals can be prepared in advance. Wills and account directives include a charitable portion, and during life, there are analogs of funds with capital management and targeted payouts. The main thing is awareness. Help where there is a resonance with your values and where the result is understandable, without compromising the basic security of your family. 31st fact. Personal finances become manageable when you maintain a double-entry system for your life, a cash flow statement and a net worth balance. Once a month, record all inflows and outflows, but not in 100 categories. 8 to 12 suffice. Housing, food, transportation, communication, healthcare, education, entertainment, and miscellaneous. In another table, list assets and liabilities, accounts, cash, investments, real estate, and electronics at a realistic price, minus loans and installments. From these two sheets, metrics emerge: savings rate, runway in months of expenses, debt payment to income ratio, and liquidity. Choose a money day and close the period in one sitting, cross-referencing statements and receipts. This fosters discipline. Store documents and warranties in one place and receipt photos in the cloud. This financial speedometer doesn't moralize. It shows the trajectory, where to accelerate, where to brake, and what hinders gaining altitude. Fact 32nd. Buying a car is a series of decisions where the main protection for your wallet is preparation. First, determine the door-to-door budget, including registration and insurance, rather than how much per month. A monthly focus benefits the seller. Pre-approved credit from an independent bank or readiness to pay cash sets the upper limit and reduces the imposition of expensive terms. For a new car, discounts on the outgoing model year and the absence of mandatory add-ons are important. For a used car, service history, VIN check for restrictions, cold start, test at different speeds, and inspection by an independent mechanic before the deposit. Read the contract carefully. Down payment refundability, penalties, deadlines, and the list of equipment in the specification. Consider extended warranties and anti-corrosion treatments as separate purchases, comparing the price with the risk of breakdown. Even before the deal, request a calculation of insurance and taxes so that the pleasant price does not turn into expensive ownership the next day. 33rd fact. Education is an investment whose return needs to be calculated, not guessed. Cost includes not only tuition and living expenses, but also the opportunity cost of time, how much you could have earned working during those years. Income is not average graduate salary, but your actual increased income in your field and region after taxes, adjusted for employment probability. It is useful to model 3 scenarios: baseline, optimistic, and conservative, including the risk that the program may not pay off immediately and will require internships. Grants, scholarships, employer reimbursement agreements, stackable certificates, and online courses that fill knowledge gaps without interrupting work can help reduce the cost. Education loans should be taken with an understanding of the full cost and the payment ceiling as a percentage of income. An important filter is the market signal, demand for skills, graduate portfolios, and employer feedback. Not everything prestigious is equally valuable. Value lies where competence converts into money. 34th fact. Moving to another city or country is a financial expedition with a base camp made of numbers. It's not salaries that are compared, but the net amount after taxes and typical expenses, rent and deposits, transport, utilities and communication, food, healthcare and insurance, kindergartens and schools. Double housing is factored in for the transition period, along with moving costs, temporary round-trip tickets, document and translation fees, and bank and operator commissions. If income is in one currency and expenses are in another, currency risk is added. This is mitigated by distributing reserves across currencies and accounts, as well as by conversion rules without excessive spreads. Tax regulations and double taxation avoidance agreements, reporting deadlines, and registration requirements are clarified. Social capital is also money. The absence of a local credit history means higher deposits and stricter terms, which can be compensated by document packages and stable income. A plan in numbers removes romanticization and provides freedom of choice. 35th fact. Small businesses and freelancers operate based on cash flow. Paper profit won't save you if your account is empty. The first rule is financial separation. Use separate accounts, cards, and bookkeeping for your company and personal life to track margins and manage taxes correctly. Pay yourself a fixed salary on a schedule. Allocate the rest to expenses, taxes, and a reserve of 2 to 3 months of business operating costs. Issue invoices to clients with clear work stages, advance payments, and terms like net 15/30. Automate reminders and track outstanding debts by aging them to avoid missing due dates. Aim to keep fixed costs lean. Rent with flexible terms, lease equipment instead of buying, and subscribe only to essential services. Compare acquiring and payment processing fees across your entire transaction volume, considering rates, refunds, and chargebacks. Liability insurance and basic cyber hygiene protect against infrequent but costly incidents. A business is also a portfolio. The key is not growth speed, but survival during tough times. 36th fact. A goal fund or sinking fund is the opposite of the impulse to take out a loan and figure it out later. The idea is simple. Large, predictable expenses are broken down into monthly installments long before the event, and the money is kept in a separate account, not mixed with everyday funds. This is how vacations, equipment, insurance deductibles, taxes, gifts, and repairs are paid for. Anything that isn't yesterday but is definitely going to happen. Unlike a reserve fund, which covers the unforeseen, a goal fund operates with a visible horizon and calendar. The practice is to give each goal a name, amount, and date, set up automatic transfers on payday, and then adjust the remainder to fit your life. The psychological effect is strong. The money is earmarked, and you won't feel like spending it on something else. It's convenient to keep short-term goals in a highly liquid account and medium-term goals in instruments with minimal risk and a small return that offsets inflation. Discipline here replaces loan interest. You pay yourself, not the bank. 37th fact. Price negotiations are not a conflict, but a process of seeking mutual benefit. Stores and services often leave room for maneuver. Seasonal discounts on last year's models, demo or display units, 2 for the price of 1.5 bundles, free delivery or installation instead of a nominal discount. Research the fair price in advance. Using aggregators, reviews, and market averages will prevent you from being anchored to an unfavorable price. Speak in terms of the full bill. What will the total be with registration, insurance, delivery, and fees? BATNA principles, best alternative, are useful. Having a pre-approved loan or a competitive offer allows you to confidently walk away if terms don't improve. Quiet strength lies in pausing and being willing not to buy today. For services, pricing works based on volume and predictability. A long-term contract, flexible deadlines, or recommending new clients are valid arguments for a discount. The main thing is respect and clear criteria. Emotions fade, but numbers remain. Fact 38. Bonds are a loan you extend to an issuer, receiving coupons and the return of the principal at maturity. However, their reliability varies. There are 2 key risks: interest rate risk and credit risk. When market interest rates rise, the prices of existing securities fall. The more sensitive they are to rates, the higher their duration. The safe haven of long-term bonds can suddenly become turbulent, which is a normal market mechanic. Credit risk is the probability that an issuer will delay or default on payments. It is assessed by ratings and the spread to the risk-free curve and diversified across issues and sectors. Yield is calculated not by coupon, but by yield to maturity, considering the purchase price and all payments. Short-term, reliable bonds act as a buffer in a portfolio. Long-term ones offer higher yields but fluctuate. High-yield bonds promise a premium for risk that may materialize. The choice depends on your objectives: a liquid buffer, a portfolio anchor, or a bet on the interest rate cycle. Fact 39. Travel tests your wallet not only with prices, but also with payment rules. Terminals often offer to charge in your home currency. This is dynamic currency conversion, almost always with an invisible markup. It is safer to choose payment in the country's currency. ATMs abroad like to impose recommended rates, refuse them, and let your bank convert according to its rules. Withdrawing cash from credit cards can deprive you of the grace period and incur a fee. It is better to use a debit card with reasonable limits, push notifications, and a backup card elsewhere. Bookings and car rentals block deposits. Consider your available balance and the unblocking periods. Data roaming is also about finances. Connect packages in advance to avoid paying per use. Medical insurance with clear limits abroad saves tens of thousands on a single incident. And finally, a simple checklist: copies of documents, bank contact information, offline maps, and a reserve of local cash. Fact number 40 states that money in relationships is not about joint or separate, but about building trust. There are three working models: a completely shared budget, completely separate finances, and a hybrid model with three buckets. In the hybrid model, a pre-agreed percentage of funds goes towards common goals, while personal expenses do not require reporting. The key is transparency: a list of accounts and debts, defined goals, insurance, and a plan for emergencies. It's important to have rules of engagement for discussing money. Talk about finances at a neutral time without accusations, focusing on numbers and the future, not past mistakes. Once a month, hold a family council to discuss the budget, progress on goals, major purchases, and adjustments. Role distribution does not equate to power. The person who keeps track of finances does not become the cash boss. Decisions are made jointly. Red flags include hidden debts, blocking access to money, or imposing loans. These are signs of financial control that require boundaries and, if necessary, help. Properly set up finances in a couple enhance freedom rather than restricting it. Fact 41. Dividends are not gift money, but a form of capital return to shareholders, which only changes the picture in conjunction with the stock price. On the ex-dividend date, the stock price statistically falls by approximately the dividend amount, adjusted for taxes, market conditions, and news flow. The company becomes poorer by that amount in cash, and you become richer in cash. The net pie has not grown. High dividend yield is often a sign of trouble. The yield has soared because the price has fallen on expectations of problems. This is a dividend trap. Dividend aristocrats instill discipline through management, but do not guarantee excess returns. The overall result is more important: price growth plus reinvested payments, DRI. Living on dividends and selling some shares are economically similar strategies, with the same risk and taxes. The differences lie in psychology and fiscal details. Buybacks are an alternative to payouts, but their effect depends on the company's valuation. Buying back expensively burns value. Fact 42. Leasing, credit, and rental are three methods for using an item, each offering a different level of flexibility. Credit is installment purchasing. You pay interest but become the owner, bearing the risks of resale and depreciation. Leasing is a contract for a set term with a predetermined residual value. Monthly payments are lower and the down payment may be smaller. But there are limits on mileage/wear, penalties for early termination, and a buyout at an agreed price. It's convenient if you plan to change your car or equipment every 2 to 4 years and value predictability. Rental provides maximum flexibility without ownership and without resale worries, but at the highest cost per unit of time. Total cost of ownership, TCO, calculations include all payments, insurance, usage limits, taxes, and penalties for exceeding norms. For businesses, accounting and tax nuances are added. Sometimes operating leases ease the balance sheet and cash flow. The choice depends on your time horizon, usage pattern, and willingness to bear the risk of the tail, the residual value. Fact 43. Capital concentration in your employer company presents a double risk. Your income and your assets depend on a single source. Should the firm encounter difficulties, you might simultaneously lose your job and witness a drop in stock prices or forfeit bonuses. This is the double hit effect. While attractive discounts in employee purchase plans, substantial RSU or options, and brand loyalty may encourage accumulating company stock, discipline is more important than emotions. A sensible upper limit for your employer's stock portion in your net worth is 5 to 10%, sometimes 15% for mature giants. The rest should be systematically diversified. In practice, automatically sell a portion upon vesting and transfer it to an index core. Consider blackout periods before reports and keep reserves in third-party accounts, not your employer's bank. In ESP, take the discount as a free lunch, but don't hold the position longer than necessary. A what-if plan for layoffs and stock price drops is as essential a document as your resume. Fact 44th. Rebalancing is the regular process of returning a portfolio to its target risk allocations. This is done to avoid becoming hostage to either good fortune or downturns. There are two main approaches: a calendar-based method, e.g. quarterly, semi-annually, or annually, and a threshold-based method, when an asset class's share moves beyond a defined corridor, say plus or minus 5 percentage points from the target. Many investors use a hybrid approach, checking according to a calendar but acting only when a threshold is breached. In taxable accounts, soft rebalancing is applied first through contributions and dividend redirection to minimize sales. Actual sales are reserved for the end and include commission considerations. A separate tool is tax loss harvesting, which involves selling a depreciated asset and buying a maximally similar one in terms of exposure but not identical, to comply with rules on substantially identical purchases. Specifics depend on your country. Within tax-advantaged accounts, the process is simpler, as taxes do not impede discipline. The overarching goal is to keep risk within limits and mechanically sell high and buy low. Fact 45th. Gold is not a wealth-generating engine, but rather insurance against certain scenarios. It does not produce cash flow, so its long-term return depends on market sentiment, real interest rates, and currency strength. At times, the metal shines as protection against inflation and financial stress, while at other times it remains stagnant for years. Ownership forms vary. Physical bars and coins require storage and incur spread upon buying-selling. Collectible coins often carry a numismatic premium unrelated to the metal's price. Exchange-traded funds for gold are convenient and liquid but charge management fees. Paper gold without physical delivery carries counterparty risk. A portfolio allocation is typically moderate, around 5 to 10%, serving as a tail hedge and diversifier that sometimes rises when stocks fall. The key is understanding its role. Gold will not replace an emergency reserve, it will not outperform the market by definition, and it requires the same rules for cost accounting and rebalancing. Fact 46th. Inflation-protected bonds are a tool where the skeleton of a classic bond is wrapped in index-based armor. The face value of such securities is regularly adjusted to the official price index with a lag, and the coupon is calculated from the already adjusted base. As a result, the investor receives a real yield above inflation. If inflation rises, the indexed face value and payments follow it. If it falls, the protection weakens, and during deflation, indexing can go down. Details depend on the issuance terms. Risks exist. Dependence on the index calculation methodology. The consumer basket does not match yours. Taxation of paper indexing before actual redemption in some regimes. And sensitivity to real rates. When they rise, the prices of such securities fall. In practice, this is not a silver bullet, but a brick in the portfolio for long-term goals where purchasing power is important. Short maturities dampen volatility, while long maturities react more strongly to rates. Fact 47th. The dollar cost averaging, DCA, and lump sum investing address one question: how to spread a large sum of money over time. Statistically, in steadily growing markets, investing immediately often wins because the money works longer. However, psychology and the risk of buying at the peak make DCA a resilient solution. DCA breaks down the task into equal installments on a schedule, reducing the likelihood of strong regret and disciplining behavior. An option for a lump sum is to invest, say, 1/3 immediately and spread the rest over 6 to 12 months according to a calendar, without looking at the news. For salary contributions, DCA occurs automatically and works excellently as a savings autopilot. The mistake is to turn averaging into an endless wait for the perfect moment. Money waits by the roadside for years and loses to inflation. Whichever path you choose, rules are important. A predetermined schedule, allocation by goals and assets, infrequent rebalancing, and a prohibition on guessing the bottom. Fact 48th. Return is not a single number, but a distribution of outcomes. And operating within a portfolio means living within that distribution. Two strategies with the same average can feel radically different due to volatility, maximum drawdowns, and recovery speed. For long-term goals, real inflation-adjusted metrics and sequence risk, the order of good and bad years, are important. For short-term goals, liquidity and predictability matter. Metrics like Sharpe and Sortino are useful for comparing risk-return, but they don't replace common sense. During crises, correlations increase, and many independent assets move together. Practice boils down to 4 steps. Define your goal and horizon. Choose an asset mix based on your drawdown tolerance, the sleep test. Calculate costs and taxes, and set a rebalancing policy. And remember, most of the success isn't about picking the best year, but about endurance and modest costs every year. Fact 49. Cashback, miles, and points are a loyalty discount that works only under one firm condition. The card balance must be paid off to zero every month. Otherwise, interest charges eat up any benefit. The maximum effect is achieved with a simple system: 1 to 2 cards for your key spending categories and 1 everywhere card with a basic cashback. Tricks with a dozen cards increase confusion and the risk of late payments. Welcome bonuses are beneficial for planned spending, not for stretching purchases to meet a goal. Miles are subject to devaluation, so accumulating them forever is a bad idea. Redeeming rewards is best directed towards real needs: tickets, hotels, statement closing, not for random items at inflated catalog prices. Watch out for foreign transaction fees, opt out of dynamic currency conversion, and read program rules, calendar requirements, partners, blackout dates. Remember that free cashback is paid for by merchant fees. Do not spend more for the bonus. Fact 50. Medical expenses are one of the most frequent financial shocks, and they are managed in advance through diligent paperwork and addressing issues up front. When choosing a policy or clinic, compare not only the premium/contribution, but also the deductible, copays, out-of-pocket maximums, and network. Out-of-network treatment can multiply the bill. Plan for preventive care. Vaccinations, screenings, and dental visits are cheaper than treating consequences. Before a procedure, clarify codes and the need for pre-authorization, and afterward, demand an itemized bill. Coding errors and duplicates are not uncommon and are correctable. Inquire about the cash pay rate, as it is sometimes lower than the insurance rate. Keep all documents, EOBs, and correspondence. Bill disputes have deadlines. While traveling, insurance covering emergencies and evacuation is mandatory. Compare medications by generics and manufacturer discount programs. The goal is not to avoid spending altogether, but to prevent a devastating surprise when health and finances hit simultaneously. Fact 51. Bank fees are a tax on inattention that subtly erodes interest and cashback. Accounts and cards have not only monthly service fees, but also charges for infrequent transactions, interbank transfers to other banks' regions, withdrawals from other bank ATMs, card reissuance, paper statements, inactivity, and exceeding transfer limits. A separate item is currency conversion. The spread is often hidden in a favorable exchange rate, and weekend rates differ from weekday rates. Free with turnover packages are good as long as you meet the conditions. Once spending drops, the monthly fee returns and the annual cost soars. Interest on balance can have a sum ceiling and spending requirements. Calculate the real annual benefit, not just up to 10% on a banner. For international transfers, compare the full basket: sender's commission, correspondent bank's fees, and the exchange rate. The total outcome is more important than a nice zero rate. It's convenient to assign banks by role: one for daily payments, a second for savings with interest and limited access, a third for travel. This reduces risk and costs. Fact 52. Time is the most valuable asset, and personal finances benefit when you calculate your hourly cost of living. A simple model: take your net monthly income, divide it by your actual working hours, including commute, overtime, and mental toil at home. This gives you a benchmark. Then compare. If grocery delivery saves 2 hours and costs less than your hourly rate, it's an investment in focus and rest. If doing it yourself takes up a weekend and requires a tool you won't use again, it's an expensive DIY. But the formula doesn't replace common sense. Some tasks pay off with skills and joy: cooking as an anti-stress, or repairs that teach you about your home. The key is not to turn saving pennies into losing big money. Long queues for a minimal discount, an extra hour of driving for cheaper gas, endless tariff comparisons instead of working. Set a decision threshold. If the savings are less than X per hour, I'll choose the most convenient option. And direct the freed up time into income, health, and relationships. Fact 53rd. Unexpected income, such as a bonus, tax refund, gift, or sale of a long unused item, can easily be spent on impulse purchases if no specific goal is set for it beforehand. A straightforward approach with flexible allocations works. A portion goes towards immediate enjoyment, fulfilling a long-held desire and experiencing positive emotions. Another portion is for the future, boosting reserves, adding to investments, or covering insurance premiums. And a third portion is for the past, accelerated repayment of debt with the highest interest rate. The proportions adjust to life circumstances. With more debt, you increase the past allocation. With an insufficient cushion, you focus on the future. The main point is not to turn a one-time windfall into a recurring expense. For example, a new subscription taken out just because can lead to years of ongoing charges. If a bonus is performance-based, a part can be directed towards training that increases the chances of receiving future bonuses, a positive feedback loop. And don't forget about taxes and deadlines. Some payments are taxed differently, so set aside a percentage in advance to prevent joy from turning into confusion during the reporting month. Fact 54th. Saving on utilities is not about wearing a sweater, but about a one-time upgrade that yields small dividends for years. LED lamps last many times longer and consume noticeably less. Smart switches and timers turn off lights where no one is present. Heat loss often occurs through windows and doors. Seals, hardware adjustments, basic attic and pipe insulation are inexpensive tasks with quick payback. A programmable thermostat reduces heating/cooling when you are away. Moderate washing cycles and air drying reduce bills and extend the life of items. New energy efficiency class appliances are more expensive up front, but cheaper in the long run. Consider the TCO. The consumption difference over 5 to 7 years often covers the extra cost. Silent energy vampires are electronics in standby mode. A surge protector with a switch can turn them off at night. All of this is not heroism, but systemic details that do not worsen comfort but protect the budget from rising tariffs. 55th fact. Tracking mistakes is an undervalued asset in personal finance. We tend to remember successful deals and forget missteps, attributing success to skill and failure to circumstances. The remedy is a decisions journal. Before a major purchase, investment, or debt, record your assumptions, alternatives, success criteria, and loss limits. Afterwards, review and compare the plan to the outcome. Such a post-mortem reveals patterns: buying on emotion in the evening, underestimating renovation timelines, overstating income, ignoring fees. A pre-mortem is also useful. Imagine a decision failed and list possible reasons. Often, what needs checking or a buffer becomes clear. Implement checklists: loan, total cost, penalties, early repayment; investment, expenses, taxes, scenarios; purchase, TCO, and return. Don't punish yourself for the world's inevitable volatility. The goal isn't to avoid all mistakes, but to make them cheaper and less frequent. Where randomness is high, evaluate the process, not just the result. Discipline beats luck in the long run. Fact 56th. The cost of investments is not only the visible broker commission, but also hidden market expenses. Even when deals are free, you pay the spread between the bid and offer. And with active trading, you face slippage. The price moves during execution time. There are storage fees, exchange and clearing fees, margin interest, currency conversion with a spread, and withdrawal commissions. For funds, this is supplemented by TER/management expenses, as well as blind spots, tracking error to the index, taxes in the fund's back office, and the cost of rebalancing. In some models, payment for order flow is common, which can affect execution quality. Practice reduces leakage. Trade less often. Choose liquid instruments. Set limit orders for unhurried purchases. Avoid thin order books on news, and compare the full basket of tariffs, not just one attractive parameter. The final result matters over a horizon of years. Extra tenths of a percent annually are unnoticeable individually, but are significant with compound interest. 57th fact: life insurance is divided into pure protection and hybrids with accumulation. A term policy is straightforward. You pay a premium and you receive a large payout upon death within the term. If no event occurs, there's no money back, but the coverage is inexpensive per dollar. Accumulation and universal products promise a two-in-one solution: protection plus cash value, which grows and is accessible through loans/surrender. However, they have high first-year commissions, complex surrender value tables, and not always transparent internal yields. Often, the effective rate is noticeably lower than market alternatives. Therefore, the goal is to cover risks, with an amount equal to several years of family expenses and large debts, for a period until the financial independence of children/partner. Beneficiaries are designated directly in the policy and should be reviewed with life changes. Sometimes a ladder of multiple terms for decreasing needs is useful. Investments, on the other hand, are more convenient to hold separately. It's easier to calculate, compare, and change them without losing protection. 58th fact: factor investing is an attempt to systematically capture premiums for stable market characteristics: value, cheap stocks relative to company fundamentals; small size, quality/profitability, momentum, and others. These premiums are not guaranteed annually. They come in uneven portions, can lag broad indexing for decades, and require iron discipline. Otherwise, an investor cuts the tail before a reversal. The risks in them are real. Cheap companies are cheap for a reason. Small ones are more fragile, and momentum breaks down on reversals. Factors are combined to avoid dependence on a single driver. Costs and tracking error to the benchmark are monitored, and the probability of long, uncomfortable periods is accepted in advance. The method of implementation is important. Index funds with a clear methodology, a reasonable depth of selection, and regular rebalancing. Black boxes with high fees and promises of alpha always are a red flag. The goal is not to trick the market, but to obtain a different risk structure that is sometimes rewarded. Fact 59th: an investment policy serves as a personal constitution, safeguarding against emotional decisions during turbulent times. It documents the objective and horizon, target asset allocations, rebalancing corridors, contribution and withdrawal procedures, a list of permissible instruments, and red lines, what not to do. A crisis protocol is beneficial. Upon a portfolio drop of X%, a freeze on new ideas for 48 hours, a ban on selling based on headlines, and a plan for contributions rebalancing according to predefined thresholds. For short-term goals, the liquidity rule applies: a minimum of N months of expenses in low-risk instruments. For retirement, a withdrawal strategy and time-based buckets. Operational details are also included: how to store passwords and access, where accounts are located, and who executes the plan in case of force majeure. The policy is reviewed annually, without regard to market noise. Changes are made only if life circumstances change, not mood. Having an IPS doesn't make a portfolio unsinkable, but it significantly reduces the cost of panic. Fact 60. ESG and responsible investing are about aligning capital with values, not about magic returns. There are several approaches: excluding undesirable industries, investing in best-in-class companies based on sustainability ratings, active ownership with voting and dialogue with management, and direct impact projects with measurable social environmental effects. Ratings differ in their methodologies and can diverge. Greenwashing occurs when marketing outpaces facts. Filters have side effects: sector biases, increased tracking error, and sometimes higher fees. It is important to evaluate data, not slogans. Emissions per unit of revenue, workplace safety, board independence, reporting transparency. Investor preferences are legitimate, but their cost must be calculated. How expected return, risk, and expenses change. Then ESG becomes a conscious choice, integrated into policy and goals, not a spontaneous trend in the portfolio. Fact 61. Financial well-being is better thought of not as rich/not rich, but as a dashboard with several stable indicators. The first is the savings rate, the portion of income converted into capital. The more consistently you maintain this level, the more predictable your trajectory. The second is the debt-to-income ratio, total mandatory payments relative to net income. Practice shows it's more comfortable to live when this portion is moderate and doesn't erode budget flexibility. The third is liquidity. How many months of basic expenses are covered by readily available reserves? It buys time and protects against bad decisions. The fourth is net worth, assets minus liabilities, and its quarter-over-quarter dynamics. The fifth is expenses. Commissions and spreads can easily erode the benefits of compound growth. The sixth is risk concentration, the proportion of a single employer, a single market, or a single currency. All these figures are not about perfectionism, but about navigation. By seeing the instruments, you notice a deviation earlier and adjust your course. Fact 62. Bank deposits and investment accounts operate under different protection laws. In many countries, individual deposits are insured by state or industry systems up to a set limit per bank and client. This is not about profitability, but about not losing the principal if something happens to the bank. Investments, however, are not insured against market fluctuations. If stocks fall, that is your risk. But infrastructure risks are reduced by asset segregation with the broker and custodian, a ban on using your securities in their own operations without consent, and regulation. On margin accounts, securities can be reassigned and further placed. This point should be read with particular attention. It is advisable to diversify not only assets but also institutions. Keep reserves and portfolios with different providers. Check licenses and reports, and store statements and agreements offline. And remember that a safe account with a high interest rate or a miracle broker with an unclear jurisdiction is a red flag even if the interface shines. Fact 63. A mortgage is a long-term commitment where savings are built from small details. Annuity payments are steady and convenient, but initially consist almost entirely of interest. Differentiated payments are higher at the start and cheaper in terms of total interest over the entire horizon. Early repayment is most effective in the first half of the term if there are no penalties, and an accelerated biweekly payment schedule provides an additional 13th payment per year, reducing overpayment. Refinancing has a break-even point. Divide all one-time transaction costs by the expected monthly savings and compare it to how long you realistically plan to live with the new loan. A low down payment often leads to mandatory loan insurance, a separate line item in the TCO. A fixed rate offers predictability, a floating rate offers market sensitivity. Hybrid products require careful reading of the fixation periods, And most importantly, you need to calculate door-to-door, including taxes, insurance, registration fees, and the family's actual plans. 64th fact: financial care for elderly parents should begin before anything happens. A clear registry of accounts, regular payments, and doctor contacts is needed, along with electronic access with different permissions and powers of attorney for finances and medical matters according to your country's laws. An instruction on what to do if the phone is unavailable is also necessary. It is useful to set limits and notifications for cards, open a separate account for household expenses with a small balance, and keep large sums in a slow account without a card. A conversation about fraud is mandatory. Never dictate codes, do not transfer money by phone call back the number from the card, do not let in employees without a request. Check for benefits, subsidies, drug discount programs, and social services assistance. This is real money. If care expenses are anticipated, compare options: a housekeeper, day centers, nursing homes, or paid support from relatives. Sign written contracts, fix the scope of services and schedule, and keep records. Predictability and documents reduce chaos. Fact 65th. The ladder of deposits and bonds is a method for managing interest rate risk and liquidity without having to guess where rates will go. Instead of one long-term security, you spread your sum into equal parts with staggered maturities, for example, annually over a 1 to 5 year horizon. After 1 year, the nearest step matures. If rates have risen, you reinvest it for a new, longer term at a higher interest rate. If they have fallen, the yield of the remaining long-term steps, locked in earlier, helps you. This way, you simultaneously have funds available soon without tying everything up for a long time, and you don't bet everything on a single rate. For a specific goal, the ladder can be tailored to a date, such as for children's tuition payments, renovations, or education. Important details include commissions and taxes, early withdrawal conditions for deposits, and credit quality and duration for bonds. A ladder doesn't promise maximum returns at every moment, but it offers manageability, a predictable cash flow schedule, and resilience to interest rate cycle surprises. Fact 66th. An anti-crisis personal finance regime is not about panic, but about a checklist of payment priorities and liquidity. First, 4 walls: housing, basic food, utilities, transport to work. Everything else is temporarily cut to a minimum. Second, immediate inventory of obligations: a list of creditors, dates, rates, penalties. For each, call in advance to arrange for deferral, restructuring, or payment holidays, because agreed terms are cheaper than late payments. Third, growth freeze: a pause in non-essential subscriptions and projects, a reshuffling of the shopping basket, switching to cash envelopes for variable expenses to regain sensitivity. Fourth, a quick micro-reserve for 1 to 2 months, even at the cost of temporarily reducing investment contributions. The goal is to stop putting out fires with a credit card. Fifth, increased income hygiene: parallel side jobs, advance payments for stages, prepayments, selling idle items. And the main thing is a ban on expensive payday loans. A short breather there turns into a debt spiral. Fact 67th. Buying used items isn't a lottery if you account for depreciation and risks. There are categories where the second-hand market is sensible. Cars aged 2 to 4 years, post-warranty with a clear maintenance history, manufacturer refurbished gadgets with a new battery and a 1-year warranty, solid wood furniture, sports equipment without hidden defects, children's clothing, and strollers. There are also items where you shouldn't save money: motorcycle helmets, child car seats with an unknown history, climbing gear, gas and high voltage equipment, mattresses, and cosmetics. A checklist for electronics includes serial number/IMEI without locks, battery and screen tests, signs of drops, completeness, and a 7 to 14-day return policy. For cars, it means VIN reports, paint thickness checks, cold start tests, mileage verification via service databases, and independent diagnostics before a deposit. Calculate TCO, shipping costs, cleaning/consumables, potential repairs, and lack of warranty. Payment should be through secure platforms/escrow, handover in a public place, and the contract should include passport details and a description of the item's condition. Fact 68. Cash and cashless payments are not competitors but tools with different properties. A card offers chargeback protection, convenient tracking, and cashback. However, it encourages painless spending and relies on infrastructure, acquiring system failures, ATM limits, or anti-fraud freezes. Cash is stable offline, promotes discipline through the envelope method, and is useful for markets/tips. But it's easily lost and hard to trace. Counterfeits and theft are your risks. A sensible mix. Everyday purchases with a card that has notifications and a low limit. For business trips, travel, use a separate card with no currency conversion fees and a backup. Keep a small amount of cash in small bills as an emergency plan. Your home reserve shouldn't be under the mattress, but in a reliable, highly liquid account. Keep only 1 to 2 days' worth at home for emergencies. During trips, avoid dynamic currency conversion and use ATMs at banks, declining their recommended rate. And yes, security is a separate ritual. Keep your wallet in a front pocket/inner bag. Shield the PIN entry and save receipts. 69th fact. Financial information hygiene saves both money and nerves. The market generates noise every minute, while useful signals emerge slowly. Frequent monitoring can provoke actions without statistical meaning. A working approach is to set an update frequency. For example, news once a day from 2 reliable sources, portfolio once a month, and strategy once a year. Prioritize primary documents. Company reports, regulator publications, and statistics are more important than social media summaries. Distinguish between facts, opinions, and forecasts. Ask for graph axes and a comparison base, and for sensational news, ask for the date and methodology. Learn to pause urgent ideas. Apply a 24 to 48-hour rule before a major transaction. Use a Why Now checklist and refer to your investment policy. Set alert subscriptions for risk/rebalancing levels, not for every fluctuation. And remember the limitations. Even experts are often wrong. The quality of the process, discipline, costs, diversification beats attempts to guess headlines. Fact 70. Capital in closets refers to frozen money that can be unfrozen by selling excess items. Start by taking inventory by rooms and categories: electronics, clothing, sports equipment, tools. Assess their liquidity, brands, condition, seasonality. For low liquidity items, it's more beneficial to sell them as a package, bundle, to reduce time and shipping. Pricing should be based on actual transactions, not desires. Look at completed sales, factor in a discount for the absence of a warranty. Photos should feature good lighting, close-ups of defects, and honest descriptions. Packaging should be prepared in advance, boxes, film, and the shipping method should include tracking. Data is erased securely. For PCs, full encryption and reinstallation. For phones, account/IMEI, unlinking, reset, and eSIM deletion. Meetings should be held in crowded places or pickup points, without prepayments to a card. For large items, use a secure locker/escrow. If there's no time to sell, donating to organizations with a receipt can provide tax benefits where applicable. Bonus: fewer possessions mean lower storage and moving costs. Fact 71. Cognitive traps quietly undermine personal finances, and the main one is sunk costs. Money and time have already been spent, they cannot be recovered, but the hand does not rise to stop. Repairs dragged on and doubled in price. I'll add more because so much has already been invested. Although rationally, only future benefits and expenses of alternatives should be compared. To complete, change the contractor, freeze, sell as is. Nearby works the endowment effect. What we already have seems more valuable than the market, and we hold unprofitable assets or things just in case. Add the inertia of the status quo and decisions freeze. Antidotes are practical. The look-forward rule, past expenses are not taken into account, a stop-loss order for projects, a loss threshold after which mandatory review is required, a pre-mortem why this might fail, and an external check of numbers by a person outside of emotions. The sooner an error is recognized, the cheaper it is, financially and psychologically. Fact 72nd. Salary negotiations are a project involving data and timing, not just asking for more. Preparation begins with market benchmarks, role, grade, region, and median salary range to anchor the negotiation in your favor, not the employer's. The second layer is total compensation. Base salary, bonuses, RSU/options and their vesting schedules, signing bonuses, remote/relocation allowances, training, health insurance, vacation, and severance pay. One component can be exchanged for another. The third layer is proving your value, a list of achievements with before/after metrics, projects, cost savings, and new responsibilities, all on one page. Timing is crucial, before the budget cycle or after a strong completed quarter. Formulations should be specific. Considering the market and my results, I request a review to/a package of. Alternatives include, if the upper limit of the range is fixed, let's discuss a one-time bonus, level adjustment, RSU, or remote work option. A calm pause and readiness for a BATNA, best alternative to a negotiated agreement, increase your chances. The outcome must be documented in writing to ensure the agreed-upon terms are not lost. Fact 73rd. Choosing a franchise in insurance involves balancing a low monthly premium with the amount of risk you are willing to undertake. A high franchise significantly reduces the premium but requires a cash reserve, as you pay the first part when something happens. If accidents or breakdowns are rare, the savings on premiums over the years will outweigh occasional out-of-pocket payments. However, if the risks are higher, e.g. for a novice driver, frequent trips, or in areas prone to natural disasters, an excessively high franchise is dangerous. It is useful to calculate the break-even point, how many months of saved premiums cover the franchise difference. In auto insurance, pay attention to glass, towing, and replacement vehicles. In home insurance, consider floods, fires, liability to neighbors, and wear and tear on utilities. Usage-based policies are available on the market. Careful driving lowers the price, but only share the amount of data with the provider that is acceptable to you. And always keep photos of your property and receipts. Disputes over payouts are won with documents, not emotions. Fact 74th. Home renovation is one of the most underestimated financial operations. The budget almost always swells if a reserve is not included. The golden rule is to add 10 to 20% for unforeseen circumstances and a strictly defined scope of work. What is included? Which materials? Whose deliveries? Deadlines and acceptance criteria. Compare at least 3 commercial offers of comparable quality. Check TIN, licenses, liability insurance, portfolio, and reviews. The contract should include a schedule of stages and payment upon result, not 50% advance for a promise. Each deviation should be processed through a written change order with price and deadline. Keep correspondence and photo documentation. Use retention of 5 to 10% until defects are rectified. It is more advantageous to rent tools than to buy them for one-time use. And for materials, consider TCO. Cheap flooring that swells after a year will cost more. Sometimes it is more rational to temporarily rent housing during the renovation period than to stretch out the work in evening mode. Time is also money. Fact 75th. Investment taxes vary by country, but the basic principles are repeated. Income can be interest, dividends, or capital gains. Short-term trades are often taxed more heavily than long-term ones. It is important to keep track of lots, when and at what price they were bought, to correctly calculate the base for partial sales. The identification method, FIFO/specific, changes the outcome. Loss harvesting allows offsetting losses against gains and reducing the tax base. But there are rules against wash sales with immediate repurchase of the same position. These must be followed. Asset location helps save money. Instruments with high current income should be held in tax-advantaged accounts, and tax-efficient ones in regular accounts. International securities may have withholding tax at source and double taxation avoidance agreements. Keep statements, confirmations, and a reporting calendar. Penalties are more expensive than savings. Clarify details according to your country's laws, but accounting discipline is universal. Fact 76. Choosing an ETF is not about its name or a nice chart, but about checking its technical specifications. First, determine what index the fund tracks, its selection and weighting methodology by market capitalization, free float, equal weights with liquidity filters, and how often rebalancing occurs. Then, consider expenses and reality, the stated TER and the actual tracking difference, which includes hidden costs and income from securities lending. Liquidity and spread are important. A small AUM and a thin order book mean higher entry-exit costs. Market orders are risky, so use limit orders. Jurisdiction affects dividend taxes and UCITS or equivalent rules. Replication can be physical or synthetic with swaps and counterparty risk. Dividends paid to your account or automatically reinvested change taxation. And remember deviations from NAV on stressful days. ETFs usually stay close to fair value, but for niche themes and markets, the gap can widen. 77th fact. Freelance pricing is an architecture where the payment method shapes the behavior of parties. An hourly rate is transparent but encourages prolonged tasks. A fixed project price alleviates client anxiety but requires a strict scope of work and protection against scope creep through a limit on revision rounds and change orders with pricing for additional work. A retainer sells access to expertise and guarantees availability, but must include an SLA and a clear scope. A value-based model, pay for effect, is possible if the outcome is measurable. In practice, 30 to 50% upfront payment, then milestones. The contract should include rights to deliverables, payment terms, net 7, 15, 30, penalties or interest for late payments, and a kill fee for cancellations. Rates are calculated based on target income, workload, and taxes, not from the ceiling. Discounts are for volume and predictability, not for requests. Track time and margins per project, maintain a buffer of free capacity. Don't take everything, and don't underbid below full cost. This kills both quality and reputation. Fact 78. Extended warranties and accidental damage protection often seem like a reasonable insurance, but the economics here are determined by failure statistics. The failure curve of technology resembles a bathtub. Early defects appear in the first months, covered by basic warranty/exchange, followed by a long period of reliability, and mass wear-out occurs closer to the end of the life cycle when many are already planning an upgrade. A paid warranty is profitable for the seller because the average repair cost and the probability of an event are lower than the policy price. For the buyer, it is justified for categories with expensive repairs and fragile use, example, portable electronics used by children. Read the exclusions. Humidity, displays, battery wear, and self-repair are often not covered. Deductibles and limits reduce the payout. Note that some cards double the manufacturer's warranty. This is a free alternative. An alternative is a repair piggy bank. Systematically set aside a small portion for future breakdowns and replace the device based on TCO. Fact 79th. Digital inheritance and access to money is an uncomfortable but financially critical topic. Keep passwords in a manager with an emergency access function for a trusted person and a second master key sealed offline. Do not tie two-factor authentication to a single SIM card, as operators can experience SIM swap. Instead, use generator apps. Print backup codes and put them in a document package. Store hardware keys in pairs in different locations. For each financial platform, record the login email, recovery methods, account number, and designated beneficiaries, as many assets transfer by named order faster than through a general inheritance case. Set up inheritance access or trusted contacts with major services. Describe instructions in simple language, where accounts are, how to pay utilities, whom to notify. Conduct drills once a year. Check that everything opens and access is current. In a crisis, what's valuable isn't technology, but preparation and clarity. Fact 80. 0% installment plans and BNPL services are not always free. Often, you pay not with interest, but with a loss discount for immediate payment, imposed services, and penalties. Compare two bills, installment price versus cash payment price. The difference is the effective cost of credit. Add the processing fee, payment insurance, SMS fees, and a possible balloon increased final payment. Carefully read the schedule. Missing one installment turns 0% into a standard high rate for the entire remaining balance. An installment plan can occupy a bank's limit and worsen your credit utilization ratio. The cost of other loans will temporarily increase. BNPL breaks down the check into small payments and deceives the sense of price. Set limits and automatic debits. Do not fall for parallel installment plans in several stores at once. If you have money on hand, negotiate for a discount and calculate the total cost of ownership. Sometimes it is more rational to pay less today than to overpay smoothly and unnoticed tomorrow. Fact 81. Inflation in general and your inflation are different things. The official index is like the average temperature in a hospital. The basket of goods and services is averaged across regions and households. The methodologies account for substitutions, people switching brands, seasonality, and even quality. A new model might be more expensive, but per function unit, it's comparable. In reality, your spending structure is shifted. A family with children is more sensitive to baby food and services, a remote worker to communication and electricity, and a renter to housing prices. Therefore, it's useful to calculate personal inflation once a year. Compare last year's checklist of spending categories with current expenses. Understand what's growing faster and adjust your goals, insurance, and reserves. Protective measures are practical, fixed rates where they are beneficial, switching providers, energy saving, negotiating income indexation, moving some of your free funds from a zero-interest account to low-risk instruments that at least partially keep up with price increases. Fact 82nd. Return policies, warranties, and chargebacks are not just paperwork hassle, but real money that often remains on the table. In many countries, remote purchases have extended refusal rights, while offline purchases have their own timelines and procedures. Payment systems limit the dispute window for transactions, after which money becomes unrecoverable. Practical experience saves your wallet. Keep your receipt and contract, video yourself unpacking expensive electronics, document defects in writing on the day of receipt, communicate through official support, avoiding messenger chats without a trace. If the seller delays a refund, file a claim with your bank using the chargeback rule, attaching a timeline and evidence. Do not sign an acceptance act without remarks until you have checked the goods. Do not agree to repair instead of return if it contradicts the terms. For subscription services, set reminders before the renewal date and save screenshots of tariffs. In case of a dispute, this becomes the very straw that pulls money back. Fact 83rd. Passive income sounds like a dream, but in reality, it's almost always either capital income or income from a system that you once built and maintain. Dividends and coupons require significant capital. Roughly 5% annually before taxes translates to 50,000 units of currency with $1 million invested, And that's without guarantees of preserving purchasing power. Rent generates a stream, but it's not free from vacancies, repairs, and dealing with people. Royalties and digital products start with months of work up front and ongoing updates. Investments under management remove the routine, but not market risk and expenses. True magic is automation. Regular contributions to low-cost index funds, auto transfers, liquidity buckets, and clear withdrawal rules. Everything else is an exchange, either more time and expertise or more risk and capital. If they promise high passive income without effort, it's usually marketing or a risky scheme. Fact 84th. A personal finance stress test is a rehearsal for bad weather on paper, which shows in advance where leaks are. Take your budget and portfolio and play out several scenarios. A drop in income by a third for 6 months. An increase in interest rates on floating loans. A surge in utility and insurance costs. A market downturn of 30–40% with a sluggish recovery. Answer in numbers. How long reserves will last? Which mandatory payments are cut first? Which assets you will liquidate and by what rules? What minimum mode of life you can maintain without debt? For the portfolio, set a rebalancing rule and a liquidity ladder for 6 to 24 months so as not to sell risky assets at the bottom. For debts, a plan for negotiations and refinancing with a pre-assembled package of documents. Check concentrations. The share of the employer. One currency, one bank. The result is a short anti-crisis protocol with contacts and a checklist. When the storm begins, you will not be composing it on the fly. Fact 85th. Geography is a financial decision of no less power than choosing a profession. Expensive city with high income versus cheap with low should only be compared after taxes, housing, and the cost of time. A metropolis offers higher salaries and career growth opportunities, but rent, transport, parking, and leisure are also more expensive. In the suburbs, housing is more spacious, but this adds cars, insurance, gasoline, and commute hours that cannot be invested. Remote work changes the equation. If income is tied to the capital market and expenses to the region, the differential becomes a savings accelerator. But consider taxes and locality premiums, medical infrastructure, schools, and climate costs, from heating to air conditioning. Hidden lines include utility tariffs, local fees, home/car insurance, and public transport accessibility. Calculate the TCO for 3 to 5 years, considering the probability of relocation, not weekend romance. Residence is a monthly financial engine that either pulls or breaks. Fact 86th. The biggest savings levers are not in takeaway coffee, but in the big 3 expenses: housing, transportation, and food. Renting slightly further from the center with good connectivity, co-living, or a smaller space often yields more impact than dozens of minor optimizations. For owned property, the mortgage rate, insurance, utilities, and repairs matter more than light bulbs. In transportation, the total cost of ownership, TCO, of a car, depreciation, insurance, parking, maintenance, is compared with public transport, car sharing, and occasional taxis. Sometimes selling a second car saves hundreds monthly. In food, the impact is not on restaurant bills, but on regularity. Menu planning, shopping with a list, and basic home cooking eliminate the impulse to order something. The one big change a year principle works. One structural step outweighs a dozen small ones. Small things also matter, but only after the big 3 are adjusted. Otherwise, it's like bailing out a boat that keeps taking on water. Fact 87th. Identity theft is a financial emergency with a clear protocol. First, document the incident. File reports with your bank and the police/regulator. Block your cards, change passwords, and revoke active sessions. Second, freeze your credit history where available. New loans cannot be opened without your permission. At a minimum, set up alerts for any inquiries. Third, change vulnerable identifiers. Your email as root access, numbers for 2FA, restore access via backup codes, and protect your SIM card with a password from your carrier to prevent SIM swap. Fourth, review auto payments and linked accounts. Remove old devices and tokens. Fifth, monitor statements, credit reports, and government portals/tax accounts. Fraudsters issue loans, benefits, and even fines using others' data. Externally, it all seems mundane. A password manager, hardware or app keys, unique logins, and a separate money email from your personal one. But this mundanity is cheap compared to years of disputes and ruined credit scoring. Fact 88. Purchasing discount points and refinancing to lower your interest rate is about calculating the payback period. For each point, you pay about 1% of the loan amount up front, receiving a rate reduction, say by 0.25 percentage points. The benefit is a lower monthly payment. You calculate the break-even point. Divide the cost of the points by the monthly savings to get the number of months after which the discount starts working for you. If you plan to sell or refinance sooner, the extra cost won't be recouped. It's important to consider taxes, insurance, fees, balloon payments, and situations where sellers or builders sometimes pay for points as an incentive, which changes the equation. With refinancing, it's similar. Sum up all one-time transaction costs and divide by the payment difference. Compare this to your ownership horizon. Always double-check the annual percentage rate, not just the nominal rate, and avoid sweet offers with low monthly payments achieved by extending the term, as the total cost could increase. Fact 89th. FIRE, or financial independence, retire early, sounds like a ticket to eternal holidays, but it relies on strict discipline and realistic assumptions. The classic 4% heuristic means withdrawing 4% of your portfolio initially, adjusted for inflation. This isn't a law of nature, but a result of historical periods and currencies. And it's sensitive to inflation, taxes, and the order of returns in the early years. More flexible guardrails suggest cutting withdrawals in bad years and increasing them in good ones, maintaining a stability corridor. Important factors include spending structure, fixed/variable, a 2 to 3 year liquidity buffer, and income diversification. Side jobs, royalties, and projects reduce the risk of being born in the wrong decade. Medical insurance and taxes are separate items that are easily underestimated. FIRE isn't about quitting at any cost, but about the freedom to choose work and pace when basic expenses are covered with high probability. A conservative plan and stress tests are more valuable than romance. Fact 90. Benefits from employers and the government are money on the table that are often overlooked. Employer contributions to pension plans effectively provide an immediate return on the deposited amount. Corporate insurance, dental care, reimbursement for glasses, EAP, employee assistance programs, tuition and certification fee compensation, as well as travel and meal allowances reduce personal expenses. It is important to check the requirements for access: minimum tenure, enrollment windows, co-payment obligations, and academic performance criteria for courses. Government programs include tax deductions for children and mortgages, subsidies for rent, utilities, subsidized loans, savings co-financing, and medical screenings. The specific list varies by country, but the principle is the same. Annually review a checklist of eligible benefits and gather supporting documents. Employers also offer discounts with partners, ranging from telecommunications to fitness. These invisible budget items do not replace salary, but contribute to a noticeable difference over time. Fact 91. A financial calendar is more important than a perfect app, as rituals outperform improvisation. Break down the year into anchor points. Payday is for automatic pay-yourself-first transfers to savings, investments, and goal pots. The first day of the quarter is for checking net worth and rebalancing your portfolio. A month before annual bills like insurance, taxes, or car maintenance, preload the corresponding buckets. Seasonality also involves money. Vacations, gifts, school expenses, heating season, all these are better distributed in equal installments in advance. A 3-tier control system works. Automate recurring payments, set reminders for infrequent ones, and designate one money day per month to close out the period and identify errors. Small friction points enhance discipline. A separate card for subscriptions with a low limit, restrictions on transfers between accounts, and a cooling-off timer for large purchases. A calendar transforms finances from chaotic bursts into a predictable route where surprises occur less often and cost less. Fact 92nd. Designating beneficiaries is a subtle mechanism for transferring money that, in some cases, works faster and cleaner than a will. Accounts marked payable on death or transfer on death transfer the asset to the designated person upon presentation of a request and a death certificate, bypassing the general probate process. For pension and insurance products, this is essentially the primary channel. However, the mechanism's power is twofold. If a former spouse is listed on the form, they will receive the money even if the will states otherwise. Hence the rule: review beneficiaries with every life event: marriage, divorce, birth of a child, relocation, major purchases. It is important to specify shares and backup recipients in case the primary beneficiary cannot accept the funds. Joint account ownership provides speed but carries risks: creditors of the second holder, conflicts, taxes. Documents must match in full names and dates and be kept together with instructions on what to do for loved ones in the first week. Clarity in paperwork saves months and thousands. Fact 93rd. A pet is not just a source of joy, but also a multi-year financial responsibility with a predictable total cost of ownership. Initial expenses include vaccination, microchipping/registration, sterilization, a basic set of equipment, a litter box/carrier, and a scratching post/cage. Ongoing costs involve quality food, annual vaccinations and checkups, parasite treatment, insurance where available, grooming and care services, and unexpected veterinary visits. An emergency operation can cost a month's budget, requiring either a policy or a dedicated pet savings account. Travel adds costs for pet hotels or documentation and transportation. Renting may incur additional pet deposits and cleaning fees. Purchasing cheap equipment often leads to frequent replacement. Quality items last for years and are cheaper in the long run. Rationality lies in prevention. Tartar buildup, excess weight, and inactivity translate into vet bills. When choosing a breed, consider hereditary risks and size. Don't promise yourself, "I'll manage somehow." The budget for the new family member must be ready in advance. Fact 94th. Renting a home is a contract with financial implications, and most issues are resolved at the outset. Document the inspection with a handover certificate, including photos/videos of each defect, meter readings, and a list of keys. Otherwise, the deposit becomes a he said, she said dispute. Read sections on early termination, rent indexation, and utilities. Who the bills are in whose name, what services are included, how the payment changes with rising tariffs or CPI indexation, and who pays for minor/major repairs. Are subletting and pets prohibited? Are there fines for extra tenants? Violating terms can sometimes be more costly than it seems. Separately, clarify notice periods for moving out and the deposit return procedure, bank details, deadlines, and grounds for deductions. Practice protects. Payment only by contract and without cash in hand, tenant's liability insurance, a separate account for utilities to track expenses. A proper start saves nerves and hundreds of dollars in the long run. The 95th fact states that hobbies and the equipment for them follow the same total cost of ownership, TCO. You pay not for the purchase, but for every hour of use. A camera is not just a body and lenses, but also memory cards, batteries, a bag, a tripod, software, service, and depreciation. A bicycle is not just a frame, but also maintenance, tires, tools, storage, and gear. The 100 hours rule helps. If you are sure that you will accumulate at least 100 hours of practice in the first year, a mid-range purchase is justified. Otherwise, start with renting a used refurbished item or club access workshop. Do a pilot. A month of rental with 2 to 3 consecutive weekends gives a realistic picture of usage without the sunk cost trap. Plan resale in advance. Choose liquid brands/models, carefully keep boxes and receipts. The exit discount will be lower. Factor in consumables and training from the start. Lessons from professionals are often cheaper than endless trial and error. Then, the hobby remains a source of energy, not a constant item of unpredictable expenses. 96th fact. A major purchase is a mini project with stages, and the process itself saves money. It starts with formulating the task, what problem the item solves, how many hours, kilometers, sessions it will realistically work in the first year, and what alternatives exist: rental, used, sharing, service instead of ownership. Then, the total cost of ownership is calculated with a horizon: price, delivery registration, accessories, insurance and maintenance, consumables, loss of value upon resale. If there is 0% installment, it is compared with the cash price. Next is the pilot phase: a test drive, weekend rental, a month of demo, the best medicine for self-deception. A cooling-off period of 48 to 72 hours is introduced, and the rule: pay only from the goal's piggy bank, not from credit. Return policies and the availability of nearby service are checked. At the finish line is the exit plan, the model's liquidity and resale discount. Such a checklist extinguishes impulse and saves tens of % of the budget. Fact 97th. Choosing a financial advisor is about the architecture of interests. Who do they serve and how are they paid is the key question. The fee-only model reduces conflicts: fixed, hourly, percentage of client assets. Fee-based mixes fees and commissions. And purely commission-based schemes live off product sales. Ask about fiduciary duty. Is the advisor obligated to put your interest above their own? Or do they work under the softer suitability standard? Check registration and disciplinary history with the regulator, who the asset custodian is, and whether the advisor has the right to manage money without your separate approval. Find out how they earn on insurance, funds, and loans. Have them disclose all commissions and percentages and dollar amounts. Request a sample investment policy, report format, meeting frequency, and a crisis action plan. And a maturity test. Are they willing to say you don't need this product and work with your budget and risks, not just select funds? Fact 98th. A market bubble rarely announces itself with fanfare. It smells of credit leverage in the masses, new paradigm in headlines, and everything growing at once without regard for quality. Signs include an explosive influx of newcomers, quick capital stories, aggressive leverage products for retail investors, companies without profits trading on fantasies of the distant future, and explanations like, "This time it's different." Protection is straightforward and unexciting. Limits on the share of a single asset and sector, prohibition of margin for long-term goals, rebalancing within corridors, a documented investment policy with red lines, and a liquidity reserve to avoid selling at the bottom. Preventive modesty helps. Assume future returns will be lower than recent ones, and don't plan your life based on the last 2 years' charts. And remember, even if the bubble isn't where you think it is, discipline and diversification will withstand more scenarios than any brilliant story. Fact 99th. Money across borders follows 3 classes of rules: payment rails, currency control, and taxes. Transfers are considered a full basket: your bank/services commission, correspondent bank's fees, the exchange rate spread, and the crediting period. Sometimes it's cheaper to send local currency and let the recipient convert it. KYC/AML requires documents about the origin of funds and the purpose of payment. Keep contracts, invoices, statements. Some countries have limits on currency export and reporting for foreign accounts, while others mandate the declaration of foreign assets and income. Double taxation avoidance agreements exist, but they operate through a procedure involving certificates and forms. Compliance is no joke. Gray bypasses can lead to account blocking. The practice is simple. Find out the rules of both jurisdictions in advance, spread risks among providers, make a test transfer, fix the exchange rate, and keep a time reserve. Borders add friction. Fact 100. Personal finance success is achieved not by brilliant ideas, but by consistent systems. Income is grown through skills and negotiations. Expenses are managed via the Big Three. Risks are mitigated by reserves and insurance. Debts are kept under control. Capital is accumulated with inexpensive, diversified instruments. And decisions are locked into a calendar, rule, and policy. Automation of contributions and goal savings jars support you on days when willpower is low. Accounting and quarterly balance sheets reconnect you with reality. Rebalancing and limits protect you from your own emotions. Documents and beneficiaries save months for loved ones. The world changes, but the invariants remain. Spend less than you earn. Pay yourself first. Avoid costly mistakes. Value liquidity. Calculate total cost, and respect risk. This is not magic, but a craft, and it works when you do it.